Hey everyone, welcome back to another explainer. Look, if you've ever just stared blankly at a screen full of candlesticks and felt, well, completely lost, trust me, you are definitely not alone. Today, we are going to solve the ultimate Forex trading puzzle, choosing the exact right time frame. We're breaking down an 11-year veteran's methodology that is going to completely demystify all that chart chaos for you.
All right, let's dive right into this top-down approach. We're going to cover the time frame dilemma, treating the monthly chart like Google Maps, plotting key levels on the weekly, finding the waves on the daily, and finally, execution, how to actually beat those algorithms.
So part 1, the time frame dilemma. Let's be real for a second, right? Both new and veteran traders experience extreme frustration here. It's this universal roadblock that trips up pretty much everyone at some point. Picture this. You see a setup on the 30-minute time frame, and it is literally screaming at you to buy. But then you glance over at your 1-hour chart, and it's telling you to sell. I mean, what do you even do with that? This conflicting information just causes total analysis paralysis. You end up freezing right when you should be making a confident move. Now, this whole paralysis thing, it's usually fueled by two main culprits. First up, indicator-based strategies. Relying way too heavily on overlapping indicators like RSI, MACD, or moving averages that just end up constantly contradicting each other. And second, those hyped-up seminar strategies. The ones I'm talking about, the London Open or the Sydney Close. Sure, they sound absolutely amazing on a stage, but when you actually sit down at your computer, they kind of lack the foundational market logic you really need. So how do we actually fix this mess? Well, the ultimate solution is top-down analysis. Basically, this is a systematic methodology that splits your charts into two very distinct buckets: analysis timeframes to figure out your overall direction, and execution timeframes to actually pull the trigger. This 11-year veteran approach is brilliant because it completely separates the act of analyzing from the act of executing. It creates this highly disciplined 4-step funnel for us. We start up top with the monthly, move down to the weekly, then the daily, and finally we hit the 4-hour or 1-hour. We're going to walk through these layers one by one right now so you can see exactly how they lock together into a totally ironclad strategy.
Moving on to section 2, the monthly chart, or as we like to call it, the Google Maps. Our veteran source uses just a brilliant metaphor for this. They say the monthly time frame is the Google Maps of Forex. Now, the really crucial thing to wrap your head around here is that the monthly chart is absolutely not for trading. I mean, think about it. It takes an entire month for just one single candle to form. You do not execute trades here. Instead, you're using this massive time frame purely for analysis to find your overarching destination. It simply tells you the primary trend of the entire market.
Let me show you just how strict this is. Say you're looking at AUD/USD, for example, and it's bearish on the monthly chart. Your overarching rule is now set in stone. You will only look for selling opportunities. Period. The monthly chart is the almighty formula here. It sets the unchangeable direction. If the big boss says we are going south, well, we are going south. It takes all that second guessing away from your lower time frames. All right, section 3, the weekly chart and plotting key levels. Now we're down a layer, and we've got a specific checklist. This is the exact spot where you plot your major areas of support and resistance. It's also where you hunt for significant chart patterns. Think head and shoulders or a double bottom. But here's the kicker. You have to make sure these patterns actually align with that monthly direction we just locked in. And why do we do this specifically on the weekly chart? Simple, strength. Levels that take weeks to form hold way more weight than some minor level that popped up between Monday and Wednesday. If a big news event hits, a 15-minute level is going to get blown to pieces, but a weekly level, that's concrete. Think of it kind of like this. The weekly time frame tells you the various bus stops as the market travels up or down. If the monthly chart is the main route on your Google Maps, these weekly key levels are the designated bus stops along the way. They're those precise zones where price action is most likely to take a breather, find support, or smash into resistance on that big macro journey. Which brings us to section 4, the daily chart, finding the waves. So because the monthly and weekly charts move at an absolute snail's pace, your main job on the daily time frame is to identify the immediate waves and trends that line up perfectly with your higher time frame analysis. This right here is our third and final analysis layer. And again, no executing trades here either. We're just confirming that the daily waves are currently pushing in our chosen macro direction. So monthly points down, weekly points down, we want those daily waves flowing downwards too.
But hey, as we all know, the market is rarely perfectly neat, right? So what happens if the overall bias from your monthly and weekly charts is south, but your daily chart is temporarily trending north? This is a super realistic scenario. It catches tons of traders off guard, and it definitely creates confusion. So what's your next move? Well, the disciplined answer? You wait. You literally do nothing until the daily time frame realigns with those bigger weekly and monthly charts. I know, it requires intense discipline, but patience is absolutely mandatory here. You've got to wait until all three of your analysis timeframes are pointing in the exact same direction before you even consider scanning for an entry.
And finally, Section 5, execution and beating the algos. All right, now it's time to lock in our execution rules. This is where all that diligent top-down analysis finally turns into actually pulling the trigger. Rule 1, you only execute on the 4-hour or 1-hour charts. Rule 2, you only take trades in the direction dictated by the monthly chart. And Rule 3, and I cannot stress this enough, you wait for a candlestick to fully close to confirm your entry. So the crucial point is, you must wait for that 4-hour candle to actually close. It literally has to finalize and lock in that data to fulfill your criteria before you jump in. Do not jump the gun while the candle's still bouncing around.
Now, I can already hear the impatient traders out there asking, but wait, what about the 5-minute or the 30-minute chart? Can't I just trade those to get in on the action? Guys, we are entering the danger zone right now. Our source material issues a pretty stark warning on this. They say anything below a 1-hour time frame is basically pure gambling. When you dive down into the 5-minute or the 1-minute chart, you are exposing yourself heavily to algorithms, severe market manipulation, and big institutional day traders. Look, as a retail trader, you are simply not going to consistently beat Oxford-educated bank traders and massive institutional algorithms on these micro timeframes. They have way more information, they whip prices up and down erratically, and over time, they will absolutely drain your account. To put it in perspective, the 4-hour chart gives you this concrete shield of reliable information. It is nearly impossible for market makers to manipulate a fully closed 4-hour candle. On the flip side, the 5-minute chart is highly manipulated, erratic, and it's exactly where those big bank algos like to play. By sticking to the 4-hour and 1-hour charts, you're completely insulating yourself from all that noise and manipulation of the lower timeframes. So what does all this extreme patience and strict discipline actually get you? 9 out of 10. According to our veteran source, when you systematically align your monthly, weekly, daily, and 4-hour charts, you build such a high probability confluence that you actually position yourself to be correct 9 out of 10 times. Think about that. You know exactly what the market is doing on a macro level, you've plotted your bus stops, you've caught the daily wave, and you're executing safely away from the big manipulators.
So I'm going to leave you with this final provocative thought to chew on. Before you place your very next trade, are your time frames perfectly aligned? Seriously, take this top-down methodology straight to your charts today. Start up top with the monthly, plot out your weekly bus stops, wait for that daily wave to catch up, and execute safely on the 4-hour. Don't let yourself be a victim of analysis paralysis ever again. Thanks so much for joining me on this explainer. I hope it completely changes how you look at the charts, and happy trading!